Now, once you saw the dollars move coming up off the floor, that impacted oil prices. It paired gains after the decision and settled down 2% at $47.20 per barrel. We do have it at $47.36 right now, but you can see all of the wild swings in these very evocative intraday pictures. So what we want to do is figure out what it means to your portfolio and real interpretation of what Jay Powell of the Federal Reserve said and what he means. Could be two different things. We bring in former Wells Fargo chief economist and president of Dynamic Economic Strategy, John Silvia, and here with us also former Richmond Fed senior economist and Jefferies chief financial economist, Ward McCarthy. Ward, right off to you. From all that has just happened, what is the number one thing that really jumps out at you in what just happened?
Well, the Fed is still trying to pursue a neutral Fed funds rate. They did raise rates for the fifth quarter in a row. And they also signaled they expect to go slower going forward, but they're not done. They're at the lower end of their range of estimates for the neutral Fed funds rate. So I think as we enter 2019, we will get a pause here for a period of time, primarily because inflation is going to be below target because of the weaker oil prices. And the Fed's going to wait for that to work itself through. And I think they'll resume with 2 rate hikes later in the year, not in the first quarter for sure, and fulfill their expectations for 2 rate hikes before the end of 2019.
We got a January meeting and we've got a March meeting. And here you go on the screen. January is even lower than it was yesterday, a 1.9% chance. Barely anything. Folks, for this one that we just saw an hour ago, we saw about a 78% chance. Look at March, 19%, John Silvia, and now May climbing just a bit up, but 22% is really nothing. Tell me what jumped out at you. I mean, to see that they're going to cut one of the 3 anticipated rate hikes next year, that is significant. What about the fact that they slightly lowered their inflation target?
I think there are 2 key points, and I'm glad to be on with my longtime friend Ward. But
I thought you were going to say longtime friend Liz.
Longtime friend Liz as well. But I will say 2 points. One, yes. Right now, Powell thinks we're at the lower end of the neutral range for the federal funds rate. And they're still saying that the GDP number growth rate is above what they think is the long-run potential. So, yeah, in looking at this in play, there is probably going to be another interest rate increase. But they are also data dependent. And it was interesting that Mr. Powell emphasized lower economic expectations, lower inflation expectations. Therefore, we took 1 rate increase off the table. So it is a more dovish tone in the sense that they are sensitive to what's going on with inflation and economic growth.
As we look at what happened today, gentlemen, this quarter-point rate hike, the president had been tweeting at it, trying to stop it. He was putting a tsunami of sort of comments about it. Don't do it. Don't do it. They went ahead and did it. They were independent. You know, how dangerous could it be in retrospect when we look back on this that they raised 1/4 point today? What do you think, Ward?
Well, I'm not sure what danger you're talking about. If it's political
economic
danger.
Recession.
Oh, I'm not worried about a recession. The U.S. economy is, it has a few soft spots, but the most important sector, which is the consumer sector, is really going gangbusters. And we've seen that in the holiday sales so far this year. And we've also seen it in the consumer spending numbers in the fourth quarter. So I don't see a recession on the horizon, at least till 2021. So I really don't think that they've increase the danger of a recession at all.
John, let's show and talk a little bit about what the president has said about Jay Powell, the man he put into place. He was very positive about Jay Powell when he appointed him. And then, of course, when he started to see that rates were going to continue to move higher and that we started at the same time, coincidence, who knows, saw a lot of volatility. This is what came out, a lot of criticism. Too early to say, but maybe I regret nominating Mr. Powell. Not even a little bit happy with my selection of Jay. And then there were rumors put out that he was angry at Stephen Mnuchin, the Treasury Secretary, because it was Mnuchin who had suggested Jay Powell. Jay Powell is not an economist. And that actually was attractive about him for many people. And he begins to see exactly what he doesn't like, because he really kind of cares a lot about the perception people have about the markets and how great they were in his first year. And now, as they've started to fall, which could be just a normal, unrelated thing, he's almost setting somebody up to be blamed for that. What do you think about that, John Silvia? And is Jay Powell in any danger of losing his job?
I don't think Jay Powell is in danger of losing his position at all. Twice during the press conference, he did reaffirm the Fed's independence. And I think he is very sensitive to the markets and is looking at the marketplace in general, which goes back to your point, Liz, that, the market sold off quite significantly. And I think part of that may be prior to the Fed meeting, there were some high-profile commentators talking about the Fed not doing anything at all. And I think maybe the market was a little bit off kilter by betting on that option, and again, combining that with Donald Trump's commentary. So I think the market may have been a little bit off, expecting no action. And I certainly agree with Ward. 25 basis points at this point is not going to be a recessionary move.
Okay. And then I throw this to you, Ward. We talked about hiking. We talked about pausing. But Peter Schiff of Euro Pacific Capital, he's a perma bear, very often when it comes to the Fed. But just yesterday, we asked him, what do you expect tomorrow, a hike or no hike? And he said, doesn't matter. And then he said, here's why. Listen.
Regardless of what they do, the next thing they're going to do is cut rates. They're going back down to zero.
Ward, is the Fed going to be put in a position where they have to cut rates?
No, I do not think so. They're in a position now where they are going to go slow because they do not want to put themselves in a position that Peter was referring to. And again, the U.S. economy is on pretty solid footing. I think that if conditions continue to deteriorate overseas, which actually will have more of an effect on our inflation than it will growth, that the Fed could even go slower. But as Chairman Powell made it clear today, they're going to be dictated by the data. And so long as the data says we're okay, then they're going to continue to probe their way towards neutral.